Hey everyone, today I want to talk about 5 ways you can reduce or completely eliminate the taxes on Social Security. These taxes can sneak up on you and hit hard. A lot of retirees are shocked when they find out how much they owe in taxes from their Social Security benefits. But this is an area where just a little energy spent in planning can have a big impact and save you thousands, because there are a few strategies that can reduce or completely eliminate these taxes. So today, I'm going to cover these strategies individually, and at the end, I'll get specific about who these strategies are most likely to benefit. Before we jump in, if you're new here, be sure to subscribe and hit that notifications bell. This is your retirement, and I want to help you get and keep every dollar in benefits that you deserve. And that starts by understanding some of the simple strategies to reduce your taxes in retirement. Now, any conversation about how to sidestep these taxes needs to be framed with an understanding of how the taxes on Social Security are calculated. So if you haven't already, you need to watch my video, How Much Social Security is Taxable. That has the short and concise calculation, and I'll link that up in the description and at the end of this video as well, so you can go watch that next. But for now, let's jump right into these strategies that can reduce or eliminate your taxes on Social Security. Strategy number 1, strategically organize your retirement distributions. When you retire, there's no rule that says you have to turn on all of your retirement income sources at the same time. If you have the flexibility, you may be able to exercise some strategy in selective timing of the distributions. For example, assume you are 62 and you retire at 67. You have $750,000 in your IRA and a full retirement age Social Security benefit of $3,000 per month. Now, to meet your retirement living expenses, you need about $7,000 a month in gross income. Now, one of the ways that you could hit this $7,000 a month income is that you could take $3,000 from your Social Security benefit, and the additional $4,000 would come from your IRA. This strategy would result in approximately 69% of your Social Security benefit being counted as taxable income, and out of that $84,000 in gross income, $7,000 a month, you'd have a total of around $65,000 in taxable income. Another option, though, that you should at least consider would be delay filing for Social Security until 70. This would increase the monthly benefit to approximately $3,720 from $3,000, which means that to meet your total goal of $7,000 per month, now you'd only need to take out $3,280 from your IRA. Just remember that only one half of your Social Security benefit is included in the formula that determines the taxable amount of benefit. So if you increase the amount that's counted at 50% and you decrease the amount that's counted at 100%, this has the potential to make a big difference in your taxes. In the example above, this would mean that only 47% of Social Security benefits would be taxable, and you'd have a total of around $53,000 in taxable income. So just by changing up the order of distributions, you'd reduce your taxable income by $12,000. Now, that does only take into account the taxes from age 70 and beyond. To do this calculation correctly and accurately, you need to figure out how much extra it would cost you to only take from your retirement accounts in those first 3 years. When you compare the two strategies based on cumulative taxes you'd pay, you may be surprised at what a difference this would make. And if you'll stick with me until the end, I'm going to give you a resource to help you calculate all of this. Strategy number 2, qualified charitable distributions. If you give your money to a church or other charity, the qualified charitable distribution strategy can provide multiple tax benefits. This rule allows taxpayers age 70 and a half and older to donate up to $100,000 annually directly from their traditional IRA to an eligible charity without counting that amount as taxable income. Here's a quick example of how this could work. John gives his church around $10,000 per year. He's retired and receiving distributions from his IRA of $2,000 per month, or $24,000 per year. Now, typically, he'll just write a check at the end of the year for his annual contribution. When it's time to file his taxes, he'll receive a 1099-R from the IRA custodian and have that $24,000 added to his other taxable income. Now, in past years, he's itemized his taxes and he's always taken a deduction for the amount he contributes to the church. But now, thanks to the Tax Cuts and Job Act's higher standard deduction, he can no longer itemize. This means that he'll have to pay taxes for the full IRA distribution. He won't get to exclude the contribution to his church from his taxable income. This is where that charitable distribution comes in. Instead of taking the full $24,000 from his IRA, John would direct his IRA custodian to send $10,000 directly to the church. That would exclude that amount from being included in his taxable income for the year. So not only would he not have to pay taxes on that $10,000, but it could also decrease his adjusted gross income and thus decrease the amount of Social Security that's subject to taxes. There's a lot to know about this QCD strategy, so if you decide to pursue this, be sure to read the IRS page that covers this. I'll link that up below, and talk to a tax advisor too. Strategy number 3, tax loss harvesting. If you can minimize your capital gains through tax loss harvesting, this can have a big impact. Capital gains are included in your adjusted gross income and thus the formula that determines how much of your Social Security benefit is taxable. So any reduction to capital gains has a direct impact on how much you'll pay in taxes on Social Security benefits. Now, one easy way to do this is through tax loss harvesting. This strategy only works in a taxable account and not tax-deferred accounts like IRAs and 401ks. Here's an example. Assume you invested $50,000 in a tech stock. Now the stock has decreased in value and it's worth $30,000. Well, you could sell the stock and wait 30 days before buying it back, or you could sell it and immediately repurchase another investment. But now you would have $20,000 in losses on paper, but your money is still invested. These losses can be used to offset up to $3,000 of your personal income, and that's $1,500 if you're married filing separately, and it can offset an unlimited amount of capital gains. Any losses that aren't used will roll over for use in future years. Staying vigilant about harvesting these losses can have tax-saving benefits for years into the future. Just be careful here not to violate the wash-sale rules. These wash-sale rule states that your deduction from the loss will be disallowed if you buy the same security, a contract or option to buy the security, or a substantially identical security within 30 days before or after the date you sold the loss-generating investment. Now, if you're thinking about doing tax loss harvesting in your accounts, it's always a good idea to talk to your tax advisor. And if you don't have one, it may be worth the money to hire one just to make sure that you're not making a misstep that could cost you thousands of dollars. Strategy number 4, change investment allocation. This is somewhat similar to the last strategy, but vastly different at the same time. If you have a taxable account, again, not an IRA, 401k, Roth, etc., certain investments can create a capital gain even if you never sell them. This is most common with mutual funds that are actively managed, but it can occur in other types of investments as well. A simplified example of this would be as follows. 20 years ago, your mutual fund bought XYZ stock. During the course of the prior year, they sold it at a steep gain. And since you mutually own the investments with the other investors, a certain amount of the gain is passed along to you to pay your mutual share the capital gains tax. Now, when you multiply this over the few hundred companies often owned in these mutual funds, along with the strong stock market performance we've had since 2010, these gains are likely going to be an ongoing issue into the foreseeable future. According to Cap Gains Valet, a website that consolidates this information, there were multiple funds in 2021 that had distributions in excess of 30%. This means that if you had a $100,000 position in one of those, your distribution could have meant an additional $30,000 in capital gains taxes. The good news, though, is that these distributions are typically announced in the latter part of the year, and attached to this announcement are certain dates. One of these dates is the record date, which essentially works as the sell-by date if you want to avoid that year's capital gains distribution. So if you have a financial advisor, talk to them about either getting rid of these types of investments or developing a strategy to monitor the gains and ensuring you understand the implications of either selling or not selling by the record date. And strategy number 5 is Roth conversions. This strategy is perhaps the most powerful. If you can build up a balance in a Roth IRA, this can go a long way towards reducing or even completely eliminating the taxes you pay on Social Security. This is because distributions from a Roth are not counted in the formula that determines the taxable amount of Social Security. If you're still working, it may be possible to make your ongoing contributions to the Roth portion of your company retirement plan. Or many plans will even allow you to convert your pre-tax portion of the plan to a Roth. But if you've saved like a majority of Americans, your retirement dollars are likely in a pre-tax 401k or IRA. These balances can be converted to a Roth IRA. But there are a few things you need to know. The first is that any balances you convert will be subject to taxes in the year you convert. For this reason, the decision to convert should only come after careful analysis of the benefit from having the Roth versus the cost to convert. The second thing to know is the 5-year rule. If you're younger than 59 and a half, Roth conversions are subject to a 5-year waiting period before any converted funds can be withdrawn. Taking money out before the 5-year period has ended could result in a 10% penalty to file your tax return. This 5-year period will apply separately to each conversion. One of the positive notes is that the conversion clock starts on the first day of the year, regardless of the day the conversion took place. For example, converting on December 5th, 2020 would stop the 5-year period on January 1, 2025. Now that we've covered these 5 strategies, let's talk about the group of individuals who can use these and make the biggest difference. In my experience with 20 years of professional retirement planning, I've identified a fairly specific band where these strategies make the most sense. Now, there's a lot of factors that come into play with this, but a general guideline is that you can most effectively use these strategies to lower taxes on Social Security if you have between $300,000 and $3 million saved. If you have more than this saved, the income being produced is often too high to whittle down. And if you're under $300,000, there's a decent chance that your income may already be under the standard deduction, which means that you won't pay taxes anyway. Again, that is a very general guideline. Things that change this would be pensions, inheritances, real estate holdings, and a few other variables. So I wouldn't exclude further due diligence of these strategies regardless of your savings level. And I know that the analysis and execution of these strategies can be confusing. So if you need some help in sorting out all of your options, I want you to reach out to my team. Optimized retirement planning with a focus on tax efficiency is our specialty, and we can help you identify areas that may be easy to miss. The first 15 minutes on the phone won't cost you anything, and we can quickly help you figure out if you need further analysis. Now, I'm going to put a link in the description below where you can see our calendar and book a consultation. And let me assure you, there's not going to be any sales spiel, just us listening to you and figuring out if you need our planning services. And if you do, you may be surprised at how affordable it is. So look for that link below. Thanks for watching.